Welcome to the Get Real Podcast, your high-octane boost of in the trenches, tell it like it is reality therapy for personal, business, and real estate investing success. With your hosts, powerpreneurs, Angela Thomas and Ron Phillips. It's time to get real.
Hey, everybody. Welcome to the Get Real Podcast. I'm Angela Thomas, and I'm here with Ron Phillips. Hey, Ron.
Lightning round, baby.
Yeah, today is lightning round. So we asked you guys to send us any questions you have about anything. Most of these are real estate related, which is cool. If any of you did not get a chance to send us in questions, you can email us questions to invest@rpcinvest.com. And we may do another one of these here in the near future. So let's get right to it.
How many did we get about how do you make your hair look like this, Angela or Ron? I mean, how many did we get on hairstyle?
How do you? I didn't see any about hair. If you have any questions about our hair, just send it on in. I'll tell you how I turned it purple. Ron will tell you how he lost his. It'll be good. So. Okay, let's get started. So, Ron, I'm just going to start reading through these. And, I think these are all for you. Somebody send in a question for me, please. Come on. Okay, so Ron.
I don't know. I think we can both handle. We'll tag team these questions.
All right. So the first one is, he specifically said, I'd like to know how Ron evaluates a purchase. So.
Well, wait a second.
Ron.
So when you guys send in your next questions, that's really messed up because Angela's sitting here and how do you guys?
I am hurt.
You should be deeply cut right now.
Deeply cut.
Should we just take a moment, Angela? Are you going to be okay?
No, I'll be all right. I'm tough. I'm okay.
I don't know. Maybe we should skip this dude's question. That was really insane.
If anyone has questions about skydiving, just send them on in.
Did we not just do a show about, the softening of the nation? And here we are talking about your sensitivities. Hey.
Oh, yeah. Well.
Woman up, Angela. We got this.
I was trying to be real here.
I know.
Okay. So this first question is for Ron, like I was saying. So he wants to know how Ron evaluates a purchase you've already made. What metrics do you use to analyze if you made a good decision or a bad one? So you've already purchased this property, okay?
That may be we might be able to do a whole episode on that, actually.
Yeah.
How to evaluate?
Yeah, okay. Short version for this one.
Okay, so this is lightning round. So I've got to get into the mode of lightning round.
Lightning round.
How do I evaluate everything? I evaluate every single real estate deal I do based on my cash on cash return, period, end of story, hard stop.
Okay.
How do I know if it was good? If the cash on cash return actually goes into my bank account, I did a good job. If it doesn't, then I really sucked it up.
I think that's a pretty good answer. Nice and simple.
That's lightning round.
I like it. Okay, number 2. So how do you know when it's time to sell?
Easy. Go back and listen to our episode on return on equity, but it's a very simple calculation. Return on equity is the same as return on investment, except for you use your entire equity that you now have. So if you've held the property for 2 years and now you have an additional $50,000 worth of appreciated gain, then you would take the $50,000 plus whatever you put down on the property, add them both together, and you would do a new calculation of return on investment using that entire number. And if your new number, return on equity, is so substantially low that you can get a better return by selling the property and buying new properties, then you should do that.
Yep. And I think I know you guys heard it, but it's really important to point out some people miss including when they do this return on equity, they forget to include their down payment. Make sure you include your initial investment in that calculation. So Cool. That was great. Okay, the next question. I'm interested in finding out the best way to invest in real estate with the least amount of my own capital. Are there other financing options? I'm only laughing because, man, if I had a nickel for every time people said, how do I invest in real estate with no money? So,
well, I'm going to answer. Angela, you chime in too, but
yeah.
What I'm going to say is that you probably shouldn't. Like if you don't have
Yeah, it's a bad idea.
Let me start over again.
Okay.
If you're asking that question because you don't have money, then the answer is then you should not invest in real estate. What you should do is do what I did when I first started, which is wholesale, because that's not actually investing in real estate because you didn't ever really buy it, right? You're going and you're negotiating a deal and then you're selling your contract to somebody else and you're taking the spread, right? Then you can get money. When you get enough additional money, then you have money, and then you can ask a different question, which is, how do I actually invest this money? Which is the question the other guy asked, right?
Right.
How do you evaluate? How do you know when you got a good deal?
How do you know if it's a good deal? Right.
Yeah. So if you don't have any money, then you shouldn't be, quote, investing in real estate, because in order to do that, you're going to have to use everyone else's money. That's not really the way it should work. You should be using, some of your money and a lot of other people's money.
No, and I think a quick side note on this. I know this is lightning round, sorry, but if by invest, if you mean make money in real estate, not invest in real estate, those are kind of different things. There's passive investing, and then there's doing real estate as a job. If you're talking about, getting into flipping and wholesaling, it is possible to get started in real estate without using much of your own money, right? Because that's how Ron got started. But you guys can listen to that story in one of our past podcasts.
Yeah, and you can buy properties subject to the existing mortgage, which means you probably don't have to use any of your money. But the problem with that is if you don't have any money and you do that, and then something goes wrong and you have to fix it and you can't,
you are in big trouble.
You screwed yourself and you screwed the person you bought the property from, which you shouldn't be doing, right?
Yep. Okay. Perfect. Thank you. Okay. This next one says, my understanding is that you can't hold your rental property in LLCs when you go through lenders that sell into the secondary market. To use LLCs, you need to go into smaller local lenders who typically can't offer as competitive of rates or terms. Is this correct?
No.
Yeah. What?
How's that for a lightning round? Bam.
I know. That was good. I haven't heard that.
I think what you're talking about, since that probably begs a little bit more of an answer.
I know. So why?
I think the reason that you're asking that question is because they will not let you close the loan inside of an LLC or a trust. You have to close it in your personal name. After that, though, it's very common to transfer it out into an LLC and or a trust. And
we have lots of people that do that.
Tons of people do that. So yes, you can do that. No.
You don't need to find a lender that will let you close the property in an LLC. You can just move it into the LLC after. Cool.
Yeah. That said, if you own like 20 houses and you want to consolidate them all into one loan, then you can do that in a commercial loan, and then they will only allow you to close in a name of an LLC. Isn't that crazy?
I know that was probably more than anyone needed to know, but that's awesome. Thanks. Okay.
And thunder.
Yes, and bring the thunder. Okay, next question. How can we obtain comps for properties that we're evaluating?
Oh, easy. Zillow, right?
Yeah, Zillow's so accurate. Check out Zillow.
Everyone should
just
go to Zillow.
Look at the Zillow Zestimate. Come on.
Listen, the Zestimate is truth, always.
Yes, it is God. Okay, no, not really.
You get comps. You can get comps from a realtor. If you're buying a piece of real estate, like if you're buying a rental property and you're doing it with a loan, you're going to get comps because there's going to be an appraisal that's going to be done.
Right. Make sure there's an appraisal, and those are your comps.
If you're paying cash for it, then you don't necessarily need an appraisal, but you can certainly opt to order one, and then you'll get comps as well.
Yeah.
So on every transaction like that, you're going to get comps. If you're out just buying something to rehab it and you need comps, then that's what realtors are for.
Cool. All right. I like this next one. This is fun. How do I know that my properties won't be upside down in a couple of years?
You don't.
Thank you. Lightning round. Yeah, we have no way of telling you that they won't be upside down in a couple of years. But if you buy for cash flow and not appreciation, you will be okay. Just don't sell when you're upside down, right?
Listen, it's the Get Real. This is the Get Real show.
Get Real.
It's not like make you feel good about everything show.
Yeah.
And the real answer is no one knows. And you're going to have to just be okay with that. So.
And all the experts out there are guessing. So best of luck.
Expert, the only job you can get and be wrong constantly and still have a job.
I love that. All right, next thing. What are 3 things a neighborhood must have for you to consider buying rental property there?
Neighborhood.
Yeah, 3 things that a neighborhood must have.
They must mean like city, not neighborhood.
Yeah, I know. Like good, nice trees.
See, and let me just tell you where my brain went, right? They said neighborhood. And
I'm like a pool.
And I'm thinking, I'm thinking about what house I want at the beach and what I want the neighborhood to look like. And I'm thinking,
a beach neighborhood. You don't want to invest there.
Yeah, I mean, it would really be nice if, I mean, there's tons of things that I really like, but they said rental. So I'm going to try really hard to go back.
Get your head out of the beach, Ron. Come on.
Okay. 3 things that I'm going to say area.
An area.
Because neighborhood, that's a whole different question. That's way different. So area needs positive job growth.
Yes.
Diversity in the jobs, right? So they can't all be one. It can't be Detroit, right? It can't be all centered around the auto industry, or North Carolina, or North Dakota, where it's all centered around oil. Can't be like that, right? So growth in jobs, diversity in jobs, and commercial development, right? So positive growth in the economy. That's the number one thing to look for.
All right. And then I think this is the same person also asked, outside of cost and business diversity, what makes it a good rental market? And I think, they're asking for other things in that area. So I would say
Are they live right now? They listen to my answer and they're live.
No. They just sent in 2 questions. I thought I should include both. So I think that they're asking, what other what else makes you look at a specific area? I know we like boring markets, right? And places that aren't a one-horse town that have, like you said, diversity of businesses. But yeah, we also look for boring markets. We don't try to buy in areas that have crazy appreciation, because with that, you have the crazy depreciation, right?
Yep. Higher risk.
So we go for the boring, low-risk markets. So there you go. And then the next one is, does cash-on-cash return include closing costs to buy in?
So if you want to do if you're not doing one that's just a very simplified version, then yes, you would put every cost you have to purchase that property in, right? So let's use an apartment complex, because there's a lot of costs that go into that. Okay. So I'm going to have my attorney's fees to create the entities. Usually there's, the appraisal is way more expensive. Sometimes there's extra reports that have to be put in there. There's lender fees. I mean, there's all kinds of stuff. So when I'm doing my return, yes, I have to take the entire amount that I'm actually investing into the property, which includes all of those things. And that's what I would figure my return on. And, you can do one really simple. If you're looking at a single family home, you can do one really simple and just say, I'm going to put 20% down. And then if you want to include your closing costs, just bump it up a couple of percent, because you're probably not going to know those immediately going in. And there's, I've got 90 days to close a commercial property, where you probably only have like 30 days to close a house, right? So, and you won't know all those costs until the end, because you're not going to get all of those costs up front. So anyway.
Okay, cool. This next person asked, I see maintenance on a pro forma, but do you also include capital expenditure in your pro forma?
Yeah, well, we dump it all into the maintenance bucket, but if you wanted to separate them out, you certainly could.
Yeah, it's all in there. Okay, that was short and easy. The next person asked, would you recommend buying houses spread out in different markets versus buying in the same market?
Okay, time out. I just want to make sure everybody understands the difference between maintenance and capital expenditures.
Oh, yeah. Okay, go back.
Two separate things, right? So I answered that guy's question. I realized maybe
someone doesn't know what that means.
Know what that is, right? So capital expenditures are things that you set money aside for, like a new HVAC in 10 years, where you say, this thing's got a lifespan on it. I know I'm going to have to replace it. So I'm going to set some money aside for the next 10 years so that when I have to replace it, comes out of my CapEx budget, right? That's different than the toilet got stopped up last week, maintenance request, done. Okay? All right.
And we include all that in maintenance on our pro forma. So,
yeah.
Okay. So the next person said, wouldn't you recommend buying houses spread out in different markets or buying in the same market?
I would not recommend either one of those. I would just recommend do what you want, because there's a case to be made for both of those. And I'll just give you the pros and cons list really quickly.
Real quick. Yeah.
If you're buying all in one area, then you have one management company that you're dealing with a whole bunch of properties.
And that's a big pro, usually.
Yeah, that makes life a little bit easier for you, a bit easier for you, right? And so that's a really big deal. It also cuts down your costs too, because you can get some economies of scale with all of them in one area, right?
Yep.
The big drawback to that is that then you're pretty much entirely dependent on that one area. So there's no diversity. You're in one area. So it's exactly the opposite with the other ones. You have diversity, which spreads your risk around, and gives you more opportunity for some appreciation. To offset maybe some depreciation that you have in other ones.
Exactly.
But you're going to work with a bunch of people, and it's it's more difficult to manage because there's a bunch more people.
Yeah,
right?
Definitely.
But I don't think one of those answers is right or wrong. I have
it's what you're comfortable with. It's what you like. Yeah. You're in more than one area. I mean, we have
more than one area, but I'm very heavily invested in two areas.
Yeah.
And one of the reasons for that is because I have a really solid property management in one that can handle a lot more properties. And so I do more properties there.
Okay. All right. So the next question is, do you generally prefer single family homes or multifamily, small multifamilies? Or is it better to, do single families have less turnover or versus, more units? Does it matter?
No, it really doesn't.
Okay.
One is not better than the other one. This comes down to planning. So, that's the reason we do a wealth plan with people, is to try to figure out what's going to work best for them and what's going to work best for their plan. So it's impossible for me to answer that question. I have both. And, sometimes my single family homes treat me better, and sometimes my apartments treat me better. And,
Okay. Fair enough. This person asked about population demographics showing less and less births to replace the aging baby boomers. What's your opinion on how this will affect the future of real estate investing?
Yeah, so I'm going to just take this opportunity right now to tell all of our listeners to have more babies.
Come on, guys, have more babies.
Hey, help the population.
Yeah.
I literally just
in Utah, it's not a problem. So.
I literally just saw something on Facebook the other day where someone was advocating for abortion and for, what do you call it when you kill old people? I forget what.
Oh yeah, it's no. What is it? Oh my gosh.
I can't remember.
Oh sure, we're blanking. Okay.
Anyway, the whole point of it was because there's too much population right now. So we need to kill off at both ends. We kill the babies off and we kill the old people off, because then we'll have less people on the earth to use all the resources.
No, I actually saw an argument that we should kill off old people instead of abortion, because they've already lived their life, and the babies are going to contribute more. So it makes more sense.
I guess if we're into killing people off, there's really not a really positive answer to either one.
No.
I jokingly, neither one of those are really funny topics, but I jokingly say that to tell you that I don't really think we've got a massive crisis on our hands with respect to population decreasing to the point where we're not going to need housing.
Yeah. Especially since less people are buying, renting numbers are going up, which is only good for us.
And the person who made these comments was obviously super studied on this topic. I think they were all of like 19. And, obviously a trusted source. So.
Hey, 19-year-olds know a lot more than the rest of us. According to them. So, all right. Next person asked if you can briefly talk about pros and cons of cost segregation in your experience.
Yes, pro.
Always pro. I know. I saw that on Facebook where Corey Peterson had negative like $2 million something on his taxes. So from cost segregation.
So if you didn't catch his episode, he's back a few episodes, and he posted his picture of his tax return, and it was negative 2.3 something million.
Yeah, that's nice.
Heavy pro on that. Here's the con. If you buy a property and you cost segregate it and you accelerate the depreciation and take that, and then you want to sell it next year, that's a big con.
You're going to have to pay for it.
Because there's all this recapture that you're going to have. So if you're planning on like flipping a property or short, long-term flip, 1 to 2 years, it probably doesn't make a whole lot of sense. I mean, you can 1031 that money and then just kick that can down the road a little further. But at some point, yeah, you're going to have to pay the piper on that deal. So if you're planning on doing cost segregation, it's more for properties you're planning
long-term hold rental. Yeah.
But man, huge, massive, heavy pro on that deal.
Okay. And we have an entire episode on that if you're curious about cost segregation, a few episodes back. This one said that you mentioned buying condos can be tricky, and they're wondering how so. Would you recommend buying condos as a rental property?
How so? Yeah, well, yes, if the numbers work. They are tricky, okay? And the reason that they are is because they always have an association. It seems like a lot of them have problems with their associations. So you've got to check that out. In addition, and by problems with the associations, I mean financial problems with the association. So you need to check that out before you purchase a condo. Secondarily to that, the financing is tricky on them. I mean, it just is. The secondary market doesn't like them as much. You're going to get hit on your rates. I think I talked in previous episodes about the ones that I tried to buy when they were fractured. Yeah. Fractured condos are almost impossible to finance. So they are a little bit tricky, but that doesn't mean that they're not a good investment. We just sold some, and they were fantastic.
They're awesome.
But the condo association is really solid financially, no problems there, and we got a really great deal on them. So even with the association fees, they were really, really good cash flow.
So this next one kind of goes with that. This person asked, "How do you vet HOAs for financial viability?"
Oh, you just ask for their financials.
Easy enough. Will they share them with you before you buy? I know they share them
Absolutely.
with us but they won't.
Absolutely.
Okay.
Yep.
Cool. All right. And then this person said, isn't an IRA still tied to the stock market? So can't that money still drop with the market? And they're asking about buying real estate in their IRA.
Okay, so no, if you take the money, so if you've got your money with Schwab, I always use Schwab just because that name is...
it's just at the front of your mind, Schwab.
Right?
Why not? It's fun to say, too.
It's kind of fun, yeah. Schwab. So if you got your money with Schwab and then you're moving it into a self-directed IRA, you're going to sell the assets that you have with Schwab right now, which were all going to be stocks and mutual funds and stuff like that, right? So you sell all that. It's going to be now in cash. Cash is going to get transferred to the self-directed IRA, and that money is going to sit there until you tell them what to do with it.
Yep.
So then it's going to sit there in cash until you tell them what to do with it. So it is not tied to the stock market at all. It's tied to cash. And if you buy a piece of real estate, then you're going to have cash and a piece of real estate. If you invest in stocks inside of there, right? If you decide to go get an Ameritrade account and attach it to link it to your self-directed IRA account, and then trade out of there, you're going to have cash, whatever stocks you own, and real estate in there. So then the stock piece would be tied to the stock, and the rest of it would be tied to whatever it's tied to, right? So no. You're in 100% control of what you tie your money to.
In an IRA, your money is tied to whatever you invest it in.
Yeah, even with Schwab. I mean, if you sell all of your stocks right now and your money's sitting in cash, it is no longer tied to the stock market. It's tied to cash, right? Or if you buy bonds with it, then it would be tied to the bond market. If you buy gold with it, then it's going to be tied to the gold market, right? So all that stuff.
Cool. All right. Next question. Is there a book that you would recommend to learn real estate industry fundamentals?
Millionaire Real Estate Investor by Gary Keller is a great one because it has a bunch of different topics in there. He covers a lot in that book. It's really good. Actually, most of Gary Keller's books are really good. Yeah.
Okay, cool. Next one, this person.
Keep going with
Sorry, what?
books. He said one book, right?
Yeah, just a book.
Yeah.
I don't know if he'll be able to remember multiples. We can give more another time. All right, this person asked, I'm thinking about buying in Indianapolis, but the appreciation seems to be very low. If I hold it for 5 years or longer, would I still have the equity by the time I do a 1031 exchange?
No one knows the answer to that question.
I know, that's asking us to predict the future. So
yeah, so
but
again, there's 4 returns to real estate, so you can't look. And if you're buying a property in Indianapolis for appreciation, that's a bad play.
Yeah,
because it's the Midwest. The Midwest is
one of our favorite markets. It's a boring market.
It's a boring market. So you buy there for cash flow. The appreciation is a bonus, right? If you're buying for appreciation, well, we've been on a solid run now for over 10 years. So if you're buying for appreciation, you might have missed the window on the big appreciation gains. And everybody can tell you whatever they want to tell you about the market. I don't really think the market's going to crash this year, but I'm no quote expert I'm no expert on the real estate market. And all of the experts, they don't know either. So anybody who tells you they know exactly what's going to happen with the real estate market this year is lying to you. And since they can't predict it, and we've already had 10 years worth of run, you got to assume at this point that you're going to get little to no appreciation. You might. Who knows? I don't know. The real estate market this time around may go for 20-year run. I don't know.
Yeah, we have no idea. But if you bought for the other returns, you still very well could have the equity to do a 1031 in 5 years, right? Depending on your numbers.
I would not buy a property after a 10-year bull run on the off chance it will appreciate.
Yeah.
As a matter of fact, I just turned down an apartment complex for the same reason, because the dude was trying to sell this to me, and he was saying they were all built as fourplexes. These fourplexes will sell for this, and next year they'll sell for this because we are on pace to appreciate for this. And I'm like, dude, are you kidding me right now? You want me to pay for future appreciation? You're out of your mind. No way in hell I'm doing that.
Right. Okay, cool. Okay, so the next one, what are your thoughts on HELOCs? Do you recommend them? Have you used them? What's the best approach?
Yes and yes. And it depends. Because it really depends on you. So when you use a home equity line of credit, which is what a HELOC stands for, home equity line of credit, that's tied to your asset that you live in. And so you've got to be really careful when you use that money that you buy something that can make both payments, right? Because now you have a home equity line of credit payment and you have your mortgage payment. So you have to be able to make both of those and still cash flow on top of that after all of your expenses, including maintenance and vacancy. So yes, if you can find a deal that's good enough to support all of that and still cash flow really well, then certainly you can use your home equity line of credit. We've had plenty of people do that. There's nothing wrong with it, but you really need to make sure the deal works to do that, because you're putting in jeopardy your home to be able to do that. So you just need to think it through, right?
It's a big decision only you can make. So, okay, well, I think that's good for this lightning round. Thanks, Ron. We have a few questions left. I think we're going to save them for lightning round 2. And we have room for more questions.
Number 2.
So if you have questions we didn't answer, please email them to invest@rpcinvest.com.
And somebody, for the love of all that is holy, send a question that is specific for Angela next time, and stop specifically for Ron. That's really unfair. can't believe anybody did that.
It's really not cool.
I mostly just wanted to bring it back up so that Angela's voice could go low again and she could be
Could go low. Okay.
Aw.
Aw. It went back to the emotional. Okay. All right. So, you distracted me. So, send in any questions you guys have. Check us out at getrealestatesuccess.com. Give us any comments, feedback you have. Like our podcast. And also check us out on Facebook at Get Real Podcasts. And we'll look forward to seeing you next time. Thanks, Ron.
Sweet.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.